Welcome to the Deep Dive. Today, we are strapping in for what is, I think, a really high-stakes ride through the core engine of the market. We're talking about the AI chip wars and the momentum in the tech market. We've pulled together a fantastic stack of material, including one source called AI Cracks, Tech Pops, Markets Reset, which gives us a pretty sharp look at where risk appetite is right now.
Yeah, and our mission for you today is to really unpack that market pulse. We want to focus specifically on these fresh fractures that are showing up in the AI infrastructure trade.
Right.
So we're going to look beyond the headlines to understand why certain stocks are moving the way they are and what these subtle shifts in, chip procurement might signal for the whole value chain.
And what a day it was to look at. The momentum was, well, it was explosive. Tech is just undeniably in the driver's seat.
No question.
It's steering everything. The numbers from our sources are striking. The Nasdaq 100 surged by an incredible 2.69%.
Which is a huge move.
Huge.
Yeah.
S&P 500 up 1.55%, and even the Dow gained almost 0.5%. But this rally, it wasn't simple, was it? It was powered by this fascinating mix of earning success and, well, what looks like some supply chain tension.
And that tension is exactly where we need to start. Let's call it the AI infrastructure fracture.
Okay.
Because the most surprising headline of the day was that NVIDIA shares, the stock that has basically defined this whole boom, actually slipped a little bit.
Right, so let's unpack this. Why did the established leader of all stocks take a dip when the rest of the market was celebrating? What was the specific news that injected all this uncertainty?
Well, it came down to a simple but, a highly consequential rumor. The rumor is that Meta, a colossal buyer of compute power and one of the world's leading builders of large language models, is actively exploring buying or renting Google's custom AI chips, their TPUs.
Wow, okay, so this isn't just a minor exploration. This is Meta, a company that has, historically relied almost exclusively on NVIDIA's GPUs. And now they're looking at an architectural rival. How significant is that switch? Just conceptually.
Oh, it's a massive signal. And this is where the technical nuance really matters. For years, NVIDIA's GPUs were the default. They were the standard.
Right.
They're powerful, they're flexible, they're essential for general AI training. But TPUs, Google's tensor processing units, are application-specific integrated circuits. They're custom designed.
So if an NVIDIA GPU is the versatile Swiss Army knife, the TPU is more like a highly efficient, specialized scalpel.
That's a perfect analogy. Exactly. So Meta exploring TPUs shows, one, they're widening their options. They're looking for multiple suppliers, which is the fastest way to introduce competition. But more profoundly, it shows they believe they can adapt their vast software stack, which is often the hardest part of switching chips, to run efficiently on a non-NVIDIA architecture. That kind of software independence is incredibly powerful.
So it sounds like part negotiation tactic, but also part search for genuine optimization. Is Meta really going to switch, or is this just theater to get a better price from NVIDIA? How real is the threat?
It's probably both, but the threat is absolutely real because the focus of procurement has fundamentally changed.
Oh, so?
It's no longer just about getting the fastest chip on paper. The new evaluation criteria, which our source material really stresses, are performance per dollar, availability, and critically, energy efficiency.
Okay, let's dig into that energy efficiency point.
Right.
Why has that suddenly become such a make-or-break metric for these mega-scale AI companies?
Because the energy needed to train and run these massive AI models have gone from just being costly to being genuinely constrained.
Right.
The efficiency gain per chip, even if it seems modest, scales up to massive operational savings when you're running a data center with tens of thousands of them. We're talking about strain on the utility grid, the sheer physical cost of cooling these racks.
So if a TPU offers significantly better performance per watt for what Meta needs, they get leverage and they cut their massive operational costs.
Simultaneously, it's a huge win.
This is where it gets really interesting for investors, though. Because you can build the most efficient chip in the world, but if the software doesn't support it, it's basically a paperweight.
Precisely, and that's what investors are watching so keenly. How quickly can these vital software frameworks, PyTorch, TensorFlow, adapt to multiple chip types? If enterprise adoption expands, if Meta can really make the TPU work easily,
then the whole AI value chain broadens out.
It does, and the spending patterns of the tech giants will evolve significantly away from this guaranteed single vendor supply. This one rumor is really the first clear signal of that competitive landscape changing.
Okay, so while there are some fresh cracks in the chip foundation, Something else was providing a tremendous lift. It powered that enormous Nasdaq surge. Let's pivot to Alphabet. It
Yes.
delivered a huge momentum story and really seemed to convince the market of their path forward.
Alphabet was, without a doubt, the driver of that session. And they did something critical. They reset expectations for the entire segment by validating their product roadmap.
And this validation, it wasn't just internal bragging. Our sources highlighted the company's newest AI model upgrades and some fresh cloud deals. But crucially, the early reviewers,
The people who actually use this stuff.
exactly, CEOs and AI practitioners who put these tools to work, they described the upgrades as a meaningful step forward in reasoning quality and speed. That is high praise from that crowd.
That external real-world validation is absolute gold for investor confidence. You know, historically, Alphabet's AI prowess was never in doubt, but the market sometimes questioned the clarity of the monetization strategy.
Sure. How does it all fit together?
Right. Now, Alphabet is succeeding in convincing the markets it has a clear, integrated runway for the next generation of AI products.
So it's not just a collection of cool lab projects anymore, it's about synergy.
Correct. When you look at their platform search, cloud, their own models, enterprise tools, they are all feeding the same central intelligence platform. This signals stability, predictable growth. And investors, well, they favor visible roadmaps backed by strong cash flows. That synergy is what powered the Nasdaq.
Okay, moving from roadmaps to reality, let's talk monetization.
Yeah.
For years, AI was relegated to future projections and, as one source put it, conference call slides. But recent earnings reports seem to provide the hard data. The proof that AI monetization is moving directly to the revenue line. This feels like the shift from hype to execution.
This is the turning point we've all been waiting for. AI stops being a promise and starts generating measurable income. And we saw proof of this across multiple market caps and even geographies.
Let's take Zoom. A company often seen as a mature business, maybe slowing down post-pandemic, it soundly beat expectations.
Yeah, and the driver wasn't just more meetings, it was strong adoption of its AI companion features among its enterprise customers.
And that's the key metric. These aren't just cosmetic updates, they're genuine efficiency tools.
They really are. Think about it. Automated meeting notes, summaries, action item extraction, multilingual captioning. These tools fundamentally reduce the post-meeting workload for huge teams.
So they save real time, real money.
Which gives Zoom a clear path to re-accelerate growth in what was a mature business. They're adding tangible, quantifiable value.
And this wasn't isolated to the US. The results from Alibaba sent a huge signal about the Asian tech landscape.
Absolutely. Alibaba impressed with better-than-expected revenue, and the engine was its cloud intelligence division. It saw a massive 34% jump.
Wow.
And this is critical because it signals that enterprise demand for advanced AI tools and cloud compute is truly picking up steam again in China. It's mirroring that global shift towards execution.
So whether it's a mature US company finding new life through AI or a rebounding Chinese giant leveraging its cloud, the message is the same.
It is. Enterprises are now paying for AI capabilities because they see immediate returns. And our sources confirmed this went beyond the giants. A whole mix of mid-cap tech names delivered upbeat guidance based specifically on AI-led monetization.
So the cone has shifted. AI is no longer a future bet, it's a current revenue driver.
Across the board.
Now let's look at market flows, how capital actually moves, because the stock that had a really traumatic surge, for almost mechanical reasons, was SanDisk.
Right.
It rallied sharply after being promoted to the S&P 500.
This is a textbook non-fundamental rally. It's all driven by index mechanics. When a stock gets added to a major index like the S&P 500, it triggers an unavoidable buying mandate.
So all the passive money, the index funds, ETFs, pension funds, they're suddenly forced to buy the stock.
Precisely. These funds, we're talking trillions in assets, have to adjust their holdings to match the index exactly. This creates massive, guaranteed, temporary demand.
Instant artificial demand.
Right. And it gives the stock higher liquidity, deep institutional visibility, regardless of whether the company even announced anything new.
But you noted a crucial caveat. Inclusion helps the flows, but what determines the long-term move?
It's always the underlying fundamentals. And fortunately for SanDisk, their rally is also supported by strengthening demand for flash memory and storage.
Which is needed for data centers, mobile devices, AI hardware.
Exactly. So the index inclusion was the rocket fuel, but the company operates in a sector that already has strong tailwinds.
Shifting gears to macro assets, Bitcoin provided a welcome sign of stability. It stabilized in the high 80s after a few choppy weeks.
Yeah, after a period defined by some sharp moves, stability itself was the great news. It seems like selling pressure is slowing, ETF outflows have cooled off, and the long-term holders are returning.
What's fascinating here, I think, is the maturation of the asset. Our sources confirm that Bitcoin is increasingly behaving like a macro-sensitive asset again. It's shedding some of that past isolation.
That's the key insight. Bitcoin is reacting to interest rate expectations, liquidity trends, broader risk appetite, much like traditional equities.
So traders are watching retail sales and PPI data now, not just crypto-specific news.
They are. As the market matures and the ETF integration deepens, its correlation with those traditional macro signals just gets stronger. Stabilizing in the high 80s ahead of a Fed meeting is exactly what traders wanted to see. It confirms that risk appetite is still high.
Okay, let's synthesize this. We've covered a lot of ground today, from Meta kicking the tires on Google's chips to Alphabet winning back investor trust, and Zoom translating AI to real revenue.
Yeah, I think we can boil it down to two critical threads for you to take away.
Go for it.
First, the AI infrastructure market is actively diversifying. Large buyers are now prioritizing performance per dollar and energy conservation. That's what's driving interest in alternatives like TPUs and directly challenging the status quo.
And second, the monetization signal is crystal clear. It's proven by earnings. Strong performance from Alphabet, from Zoom, from Alibaba. It all shows that AI features are no longer abstract ideas. They are actively driving quantifiable revenue growth right now.
And looking ahead, there are some specific indicators the market is watching that we should all keep an eye on. That includes more updates on these big AI chip procurement deals. And of course, today's retail sales and PPI data right ahead of the Fed meeting, that's going to directly impact liquidity and rate expectations.
And finally, that one critical factor you mentioned earlier, the one that underpins all of this, the ultimate constraint.
Right. This raises a really important question that goes beyond just silicon and software. Our source material noted that the market is watching energy and power market signals as AI infrastructure demand builds.
We're deploying data centers
Yeah.
at a scale we've never seen before.
Each one demanding the power of a small city. So if you connect this to the bigger picture, the question is, how far can the AI boom truly go? How much compute can we bring online if the energy infrastructure required to power it all doesn't scale at the same pace?
So that constraint, reliable, affordable power might be the ultimate limiting factor on AI growth going forward.
It could be. It might even shift investment focus away from just the chips and towards the utility infrastructure needed to support them.